Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our first monthly research briefing of 2022. CAPIS would like to thank everyone who's joined for taking the time out of their busy day to spend with us. We hope you find the following information in today's briefing insightful and that it sparks debate about the capital markets and trading strategies. In order for us to serve you better, there will be a brief survey at the conclusion of the call. We'd really appreciate you taking a minute or two of your time to fill it out. Now, we have the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within the presentation are for the sole use of institutional investors. Nothing in the presentation should be construed as an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any possible securities that might be mentioned. And now we'll begin with our call. I'd like to turn it over to our very special guests, Market Policy Partners. But before I do, please note that John and Brendan will be taking your questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom. I will be sure to get to them. And now I'd like to start by introducing John Fagan. From 2014 until September 2018, John was director of the U.S. Treasury's Markets Room, and prior to that was a senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indexes, foreign exchange, and the rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law School. And now, of course, Brendan Walsh. From 2006 to 2018, Brendan was a senior analyst at Discovery Capital Management, where he covered the global financial institutions section and was part of the global macro team, focusing on macro data, rates, foreign exchange, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development and was an International Travel Fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, as always, welcome.
Thanks very much, John. We appreciate the kind introduction. And you can find us, for everybody that's listening, thank you for tuning in. And you can find us on the web at marketspolicy.com. So we'll jump right into it. It's obviously macro has been in the driver's seat for months now, and we're seeing some the themes that we're identifying for 2022, and these are the themes that we've been focused on now for a number of months, is really the Fed's pivot. Obviously, the Fed's pivot toward inflation fighting, and the concept that we're focused on is really the degree to which the Fed and the risks that the Fed overcommits and is in fact, oversteering into these twists and turns in its policy posture. Pretty clearly we saw the Fed be exceptionally dovish for an exceptionally long time. The formulation, and it's not that long ago, was as characterized by Fed Chair Powell and the majority of the committee was, we have to keep the pedal to the metal here in terms of monetary accommodation because of the Delta wave and the impact on the economy. To oversimplify slightly, the formulation has completely flipped, which is the Fed is now telling us that they have to tighten monetary policy because of the expected impact on the economy from the Omicron wave. So the tunnel vision of the Fed in the Delta wave and before was really on the growth impact. And that tunnel vision has shifted over to the supply side impact, the inflationary impact, and this is really where we find ourselves today. We have our call from the fourth quarter of last year. We're carrying it over into this year. Is that the Fed is basically in a overcommitted stance toward inflation, fighting inflation, and we'll talk a little bit more about inflation specifics, but inflation that is by really any metric to a great degree driven by supply shocks and supply issues that are ongoing and are truly being exacerbated by the Omicron wave. But this is the risk here is that the peak inflation fears in the market were last year, and that the Fed is going to be fighting last year's battle at a time when inflationary pressures are, in fact, on the wane. The Fed is leaning further into its inflation fighting stance as inflation ebbs and the inflationary impulse ebbs, and the risk is that a cyclical slowdown, moderate cyclical slowdown, materializes in the U.S. economy, and the Fed finds itself hiking rates into a supply shock situation, an energy shock situation, and a cyclical slowdown in the economy at a time when geopolitics is very challenging, and the U.S. is suffering a fiscal drag on the inability of fiscal spending to fill in the gaps we saw last year. As that impulse from last year peters out, essentially the growth was stolen from this year and pulled into last year, and the Fed finds itself tightening into a cyclically slowing economy, and inflation is the impulse remains strong enough for them to stay hawkish, but is increasingly isolated in that supply chain, supply shock, energy shock kind of dynamic. This isn't a great, obviously, this is not a particularly exciting setup, but a challenging backdrop
and
for
even
risk assets.
It was kind of simply, just to kind of take it psychologically rather than economically, when the market is universally focused on one negative, and that's become consensus, usually the opposite tends to happen, that we've over worried about it. So you should probably take the opposite side. And also just going forward in terms of how many now rate hikes are priced in for 2022, where, we went from like 0 6 months ago. Now some Wall Street banks are talking about 6, but we have like 4 on the table. Some people are talking about 50 basis point surprise in March. The market is historically terrible at predicting how many times the Fed is going to hike. The market is always way too hawkish.
Yeah, that's absolutely right. We're taking the under, and just how far under, I think, remains to be seen. We think it's too early to fade to fade the Fed right now. We think that it becomes more clear in the late spring, early summer.
Yeah, you want to see that March meeting. I think that's where they'll send their. You have whatever 2.5 months of reality of Omicron, and maybe, knock on wood, would be on the backside of the Omicron, and the world could be looking like a very different place come the spring.
Yeah, that's certainly true. And if we get into a situation where Omicron really is the last gasp of the pandemic, let's hope. But then the ramifications are
right with the transition from the pandemic stage to the endemic stage.
If that is a smooth handoff in the second half of the year, then the Fed can hike rates into a pleasantly rising economy, and
right, and that can be a bullish
would
tightening.
ebb.
Yeah,
right,
because we're tightening for the proper reasons, not because we're behind the curve in inflation, but because actually growth is so good, and it just doesn't need to be so insanely stimulative as it is currently.
And that really underlines our kind of thesis of a year of two halves, where we start out the year with a lot of macro cross currents, a lot of volatility, and the Fed, starting their hiking cycle, doubts about whether it is appropriate, whether rate hikes and monetary tightening are the appropriate prescription for price increases that are so still driven by idiosyncratic and energy prices and so forth. The geopolitics are going to be driving energy prices higher. We'll talk a little bit more about that, but this is clearly the disruptions that are happening, not just in Libya, not just in Kazakhstan, not just in Nigeria, but the wherewithal and the willingness of Russia to use energy as a weapon. And this is a huge unknown. We haven't seen a geopolitical risk. I mean, in years past,
well, also Russia is looking to use weapons as weapons.
Yes, that's true. That's true too. Yeah, a geopolitical risk premium in oil prices, you had to use a magnifying glass to identify one. And this is certainly a new reality that we're experiencing here, where it is priced in. That uncertainty, we think, is going to be concentrated in the early part of the year. But the Fed has now committed itself to hiking into a energy shock, right? I mean, this is a Fed that is going to have a hard time pivoting from its current, to the extent that oil price increases are actually sapping the consumer and are based on not on great demand, but on choked off supply for adverse reasons. that are impactful of sentiment on a negative in a negative way.
Yeah.
The Fed is going to have a hard time, trying to, now that it's committed to bringing inflation down. It hasn't really made the distinction between energy price inflation and what it's and it hasn't made the case exactly what its tightening policy can do. So we think that this is going to be the theme of the first part of the year, which we expect to be sloppy, choppy. We think that the yield curve will flatten and into this as growth expectations remain a little bit more cloudy and questionable, while the Fed gets increasingly aggressive in the first part of this year, despite
it's
the
also
fact.
an interesting dynamic where, in recent years, and this has been going on since, the Nixon times, but the politicization of the Fed, where before the recent turns of events, you would have expected the Democratic administration to be pushing pressure on the Fed to remain easy, especially going into the midterm election. But in the last 2 months, inflation has become a huge political, hot potato. And we saw from President Biden's poll numbers, but also to his press conference yesterday, fighting inflation is now a top priority of the administration. So that's not ironically, but it's kind of flipped, where now the administration currently would be supporting the Fed in trying to tame inflation rather than to keep things as hot as possible.
Yeah, that's certainly the case, and you can when policymakers pivot toward a particular direction, they change their minds long past when the market has. And so our expectation is that the market calms down about inflation a lot earlier than the Fed and policymakers in Washington D.C.
Politics too.
Yeah, and it's
well, today the central bank of Turkey actually paused after 500 basis points of cuts, and it was supported by President Erdogan. When you're running at 36% inflation, that can cause a little more political upheaval than where we currently are at about 7%.
Yeah, so diving into a couple of the specifics on our call of basically the theme of reflation in reverse in the first quarter of the year, higher volatility in equities into the first quarter and bleeding over into the second quarter has been our call and remains our call. Our expectation that
the huge rotation from growth to value. We're seeing somewhat signs of maybe that bottoming a little bit, especially with the tech sector. But the tech sector had a pretty great couple-year run. So
yeah. And so the monetary elixir that had gotten it so excited is definitely draining out of the punch bowl at this point. Our expectation for a flattening yield curve it continues. The pushback that we've gotten most is on our dollar call. We think that the dollar will continue its uptrend. We don't think it's a straight line. Obviously, it's not a straight line. The dollar has had a very bad start to the year. This is it's an interesting dynamic. We think that the dollar decoupling from real interest rates we think that is just an aberration. We think that the dollar recouples with real interest rates in the U.S., which we think will continue to shoot higher here through the first part of the year. We think that the Fed is going to be more hawkish than its global counterparts. Certainly, the ECB. The ECB is still
right. And we saw that from the minutes today, and President Lagarde's kind of pushback that they're not ready to follow the path of not just the United States, but really most of the rest of the world.
They're still in team transitory.
Yeah.
And you can see with their disinflationary past why they would be. Certainly, the Bank of Japan is in that in the same boat.
Right.
We think that the Fed.
Yeah, he said that there's no way we're raising rates.
Right. We think that the Fed, with the zeal of the converted, becomes stays very hawkish in the first part of the year here. We don't
also
think
an interesting dynamic with the Fed, and especially their balance sheet, that I feel like it's somewhat underreported. We talk too much about the unwind of quantitative easing and how much they're going to reduce their purchases and the time of it, but that's the numerator. We're not talking enough about the denominator, which is the amount of debt that needs to be issued, it's already started. It started back in November. We're coming to a fiscal cliff because we're running a year after 2 years of massive COVID-related stimulus. So the amount of bonds that are available to buy going forward in 2020 is half or 2/3 less than it was in the previous years. So there's just also less debt for the Fed to buy. So even if they do reduce the size of their purchases as a percentage, they still could be buying a similar percent of new issuance.
Yeah, and we think that there's going to be plenty of demand for safe haven assets through this very choppy first quarter, and we think that weighs on the longer duration treasuries and doesn't invert the yield curve, but continues that flattening, that gravitational pull toward flattening. The dollar call. So our expectation is that the dollar does find its footing here and continue higher. Again, we think it's a combination of safe haven assets, of real interest rates rising, of the more the relatively hawkish Fed. We also think that this is a China story. We think that obviously our call has been since the fourth quarter of last year, also for a lot of last year, that the Chinese authorities would get much more into the stimulus game coming into, or what basically we thought coming out of the Lunar New Year holiday. They've gotten a jump on it. They've pulled some of that easing forward. We think that they're going to be increasingly aggressive, and that puts them very out of step with other global central banks. We think that the renminbi's preternatural strength here is going to be something that Beijing needs to turn down in order to execute a reflationary dynamic in their economy going into October's pivotal political moment for President Xi, where he gets his unprecedented third term. This is a highly stage managed.
While we do have the Olympics coming up, that's a little more of a sideshow for China at this point. The real focus of maintaining economic stability is the October, I suppose, crowning of Xi, right?
Yeah, it'll be his unprecedented third term, and that is an event where obviously the Chinese authorities are looking to leave little to chance. And have an economy that is in fine shape. Our call on property has been that they are successful and eventually successful in preventing Evergrande and its beleaguered sector mates from metastasizing into systemic crash or real problem. We think that the easing that they're doing right now does help put out does dial down that systemic risk. We think it's still a drag. But that the Chinese have enough policy wherewithal still to keep the worst case outcomes very much at bay, and are laser-like focused on doing that now. That does not mean that we've been our longstanding negative call on Chinese assets. We think that if you're looking for a fleeting bounce, maybe it's a trade. But that's not what we've been advising our clients that are more in the medium to longer term investment space. This is something that we think that over the medium term, the risk reward to Chinese assets is still very challenged by the common prosperity push and some of the other dynamics underneath the surface. We don't think that this is a game changer kind of stimulus that they're engaging in. It's a rearguard action. And they're going to do as little as they possibly can. They don't want to use a cannon of credit. It's gotten them in a very challenging macro position at the moment, and we think that they do as little as they possibly can get away with in terms of stimulus to keep the property market from falling in on itself, and the economy at least chugging along into October, but not.
And you also couple that with what is now a universal consensus hawkishness towards the Chinese on the behalf of America. There's no constituent really here that kind of still believes that will converge into one big neoliberal society.
Yeah, that's right. Being based in DC as we are, we've followed this for a long period of time, and the consensus remains rock solid. Obviously there's some political point scoring where the Republicans try to paint, and this was something that President Trump tried to paint President Biden as soft on China. That's really not the way that they've operated overall. We think that they're going to keep the restrictions in place tighten them going forward. And really, we think that the
Yeah,
multilateral
and actually, a good example of that is keeping the tariffs on. And Biden's poll numbers are terrible heavily because of inflation. That is actually something he could do that would actually have a relatively quick effect on a certain amount of our goods. But they're not even talking about that.
No, and we think that is, it's a political reality. It's also a national security reality.
Yeah.
There's really no constituency for going soft on China at this point, and we think that trend continues. It's a campaign. These are all like facets of our expectation that the renminbi has topped out against the dollar. We don't think that a stronger renminbi is the solution to Beijing's problems. They obviously don't want it to depreciate swiftly. This would be a very stage managed move. So we're still moderately bullish on the dollar going through the first quarter and into the second quarter of this year. And obviously, like if this is the time for the carry trade and it's a weak dollar trade, I think that there's a self-defeating element there, because the Fed has told you that they're going to fight a supply shock. If the dollar goes down, oil's going higher and higher. And the Fed, if the dollar is weakening now because all the tightening is priced in, well, guess what? A weakening dollar will make the Fed in its current posture be more aggressive. We think. So it's not a circumstance that they can countenance in their current inflation fighting posture. So moving on to the legislative look before we turn it to Q&A. Build Back Better, our view
This
is
can be a quick one, right?
Yeah, that it would be diminished and far less than the headline number. It's even less than, it's obviously going to be even less than we expected, perhaps even a donut. But the reality is,
I still do think they passed something, whatever is amenable to. I mean, the Biden administration said it today that's what they're working on now.
We still think
and Manchin's much more the one that's. Cinema's not really holding back Build Back Better. This one really comes down to Manchin. So if you find a number that he's okay with, you might as well just take a.
And that's what they're that's what they're probably going to do. Is it $1 trillion? Probably not. Is it, are there social programs that are going to be,
you throw in some other stuff and you can make it look like $1 trillion, but it actually won't be.
Right. Yeah. So it's a diminished Build Back Better. We think that they do get something. Obviously, the voting right now, the pivot to voting rights has basically petered out in defeat. Then we're going into we're going to pivot back to Build Back Better and get a little something, and then they're going to run on that into the midterms, which is reelect us and here's what you get.
Yeah. So you have like a month or so to kind of pass this Build Back Better, and then you start running for office.
Yeah, and everything that falls off the back of the truck on Build Back Better. And remember the American Families Plan? Remember that? That was like a whole other like multi-trillion-dollar social program package that is still out there. That and the cast-offs from Build Back Better and some select pieces of the American Families Plan will be what the Democrats run on, reelect us, and here's what you get. I think that there's the Biden administration is not changing their tune on this because of inflation. They're saying it's disinflationary, it helps lower income families meet the challenges of inflation and so forth. So we don't think that they're going to be dissuaded by the current macro environment from continuing.
And when it comes to the midterm elections, the polls are looking very strong for the Republicans when it comes to the House, but I would advise to kind of just wait on the Senate. This Senate is a little more idiosyncratic than the national poll numbers would indicate. Like a place like Pennsylvania, we don't even know who the Republican is running for. So I think it's a little too early to predict that you'll also have sweeping Republican victories in the Senate. That one could be a lot closer than what looks like to be playing out in the House.
Yeah, and just some other sort of lower priority legislative stuff that we're looking at. The Senate passed a competitiveness bill last year. It looked like very much like an industrial policy bill. And it looks like the House is pivoting back toward that. And we think that something goes across the line. It's very obviously targeted at China about funding the reshoring or offshoring from China, U.S. strategic supply lines, putting investment in strategic technologies and so forth, and had enormous bipartisan support. This is however you feel about industrial policy. industrial policy is now increasingly intertwined with national security policy. This isn't a bipartisan, this isn't a Republican or Democrat thing. This was Trump started this in a really meaningful way. And the Biden administration is continuing to take this and run with it. And the national security element really is an animating factor. And I think that it's a trend that's here to stay. Execution obviously is going to be tough and over a long period of time. These are long cycles, but certainly something to watch. And speaking of execution, the bipartisan infrastructure bill is now shifting into execution mode. We expect to hear over the next couple of weeks exactly how the Biden administration is going to orient its federal infrastructure to guide and fund these programs. In the past, obviously, you didn't have a national infrastructure policy. The national infrastructure policy was fix what needs fixing. And so if there was federal money involved, you gave federal money to the states and said, go fix, you guys are closer to, your own bridges and roads, go fix it. But this is a different beast. This is a top-down, federally led infrastructure campaign. This is going to be much more directed and hands-on kind of effort. We think that is going to lead to the empowered czar of infrastructure and a federal body that we think will be housed at one of the agencies or institutions, federal agencies or institutions that will be charged with with prioritizing, funding, and guiding some of these programs. And we want to plug here we're working closely with a group, the Skyline Policy Risk Group, and this will be the subject of and they'll be featured on future publications by Markets Policy Partners and also future events. The president, Lawrence Smith, came from the Transportation Department, and he was in the policy office there. He's an expert on supply chains. He's an expert on transportation, infrastructure, logistics, and having his insights is something that I think is tremendously value add from a macro perspective, but also from a bottom up perspective. So watch this space. It's a very exciting thing for us, and there couldn't really be more a time when this is more relevant for the investment community. So why don't we pause there, open up for some Q&A, and see where the questions take us.
Okay, guys, thank you. The first question has to do actually with supply chain in America, and it's something that we were talking about offline. One of the questions here is, why can't I find certain products in my food store still? I know Brendan and I talked offline about the great cat food disappearance. Where did it go? I have toilet paper, but no cat food. So maybe we could talk about that for a minute.
So we're going to be quoting Lawrence Smith from Skyline Policy Risk Group a lot in this. Supply chains aren't, there's something that most macro folks haven't looked super closely at until the pandemic came along, and understanding the complexities. You need to really get down into it, you need an expert to guide you through it, and Lawrence Smith is that expert. But when we talk with him, he's really focused on these transportation bottleneck nodes, whether it's the port at Long Beach, port at LA. I mean, the inability of products to be offloaded and transported in an efficient way, in the way that they had been under normal life conditions. The number of drivers out sick, the vaccine mandates that are impacting employment in some cases, and whole production plants of foods and supply lines and so forth being, basically getting a sick out, and finding that they're, even if they are producing at the old rate, that the goods don't move in the way that they used to. It's a very challenging situation. It's not something that that policymakers have great answers for. So when you're looking at things like how to get the port, how to get Long Beach moving, right? It's like empties. Brendan, you talked with Lauren a lot about this. This empties.
Yeah, one very simple thing. So each container is also not the same. There's different types of containers, so you have to have the proper one. But Long Beach had an ordinance that you can only put 2 on top of each other. So there was literally nowhere to put the empty containers, and that was causing the huge amount of backlog. Luckily, some experts were able to kind of bring this up, and Long Beach changed the rules, so now you can put 5 on top of each other, which did a lot to allow then the trucks to come in to get to drop off an empty container, pick up a full one. So very simple things like just local ordinances have played a huge role. But also the Long Beach and Port of LA 2021 numbers came out, and they both have record years. So even though they have massive backups, they also process more ships and containers than they ever have before.
And one of the points that Lauren makes is that this is obviously happening when people have shifted their consumption to goods from services. We all know that. There was also a very big pre-holiday push because everybody heard about unless you were living in a cave, you heard about the supply chain problems that were coming down the pike. You'll never be able to get your holiday gifts and so forth. And so people ran out and did a whole lot of shopping way ahead of when they would have. And so that was, but the holiday season was not a disaster. So the supply chain sort of had a bend, don't break moment there. Clearly there are hiccups and hangups. That's not just domestically. China's zero COVID policy is a big challenge for supply chains. They shut down entire cities for just a handful of cases. That to us seems absolutely, alien and draconian and crazy. But that's part of the, that's how the Chinese government has oriented themselves toward COVID, particularly at this sensitive moment and ahead of the Olympics. Even if there were no COVID, there'd be a lot of factory shutdowns ahead of the Olympics anyway in China, because they always want clear skies in Beijing for these events.
But there's no fans this year, so you can just use Photoshop.
No, they have to shut down. Your athletes would be dropping dead. Have you been in Beijing on a pollution day? You can't see down the street. And it's incredible. So they had shut down all the big polluting factories in Inner Mongolia for like a month ahead of the Olympics. They would do that anyway. And so it's a situation in which the supply chain issues, Lauren thinks that there is going to be an Omicron and China related sort of, re-stressing of that system here in the near term. But he thinks that with the amount of focus that is being brought to bear on it now, not just by policymakers, but by the companies themselves, by the port operators. And he notes very astutely that this is a contract year for the unions, for the Longshoremen's Union in California. I did not know that, but apparently
it was announced today that they're looking to unionize.
So this is a big year for the for ports in the West Coast, and so
it was auspicious timing for those guys to have their contract run out. When everybody needs them more than anything in the world.
So there's a dynamic. There are a number of dynamics that we expect, and based on our expert advice, we expect supply chain constraints to get better after getting a little bit more stressed in the very near term here.
Okay, I have 2 other questions, but we'll take the one about China first. And simply put, this person asks, outside of China, where are you looking globally for any geopolitical risk?
Oh boy, so Russia, Ukraine is. When we talk with our security, our security specialist advisors, they're expecting a major incursion into Ukraine by Russia, and what that means for the sanctions regime, what that means for the response of the West, the counter response from Russia, energy as a weapon. Obviously, Russia can only go so far because they need to sell that. They need to sell that energy. To fund, to fund their country and their war effort and so forth. It's a dismal situation, very grim and disturbing. But clearly, the geostrategic and geopolitical premium that oil prices seem to house for a long period of time that maybe dwindled dwindled in the post GCF era is coming back here, and this is at a time we think, when there's, obviously Libya is a big problem. We have our security experts are talking about the situation there just not getting better, probably getting worse before it improves. And certainly the Kazakhstan that seems to have calmed down, but these flare-ups keep occurring, and so and that's not even mentioning the Houthi, the very
Right.
repeatable drone attacks on infrastructure in the UAE executed by Houthi rebels with drone technology. If you remember, these are the exact same, Iranian-linked militants based in Yemen that took out half of Aramco's production capacity with again, a very repeatable drone strike back in, I believe it was 27. When was that? 2019.
No, it was either 2018. I think it was early 2019. Which
2019.
also, that's a good. I'm glad you brought it up. I was thinking about it earlier, where when that happened, the oil markets rallied a few percent for a day and then just went back to where they were. That's not the case. It's amazing how much things have changed in about 2.5 years.
Well, yeah, and so much of that is the U.S. as a swing producer. Now,
Right.
Politically, obviously, the take from the conservative side is that the Biden administration has discouraged and is with its boot on the neck of oil producers here in the U.S., ruining the industry and so forth with overregulation and so forth. Maybe a story there that may be, that certainly seems like it's a credible narrative. The extent to which that is the locus of the issue and in the shale patch is something that I don't have super clarity on. When you listen to the Saudis, their view on the shale patch is it's a much more mature industry now. The shale patch used to be just like the drill baby drill, go for broke, very fragmented and wildcatting,
consolidated much more into the big guys, and you don't have that small swing factor that as soon as they can they'll pump.
Those big oil price busts that we saw in 2014, we saw another one in like the 2015-16. It was a very challenging time for oil prices, the consolidation that happened, the ups and downs, and so the Saudi oil minister has said repeatedly that the shale patch is a place of real output discipline. And certainly there is, probably a regulatory constraint element there as well. So is the Biden administration going to change its stripes and go easy on the producers? Probably not. And so this is at a time when, we're seeing so many of the geopolitical supply issues and the lack of investment over a period of time come to roost. We're not that bullish on oil, as there are lots of calls for like $100 barrels of oil, and we think that with a estimating a cyclical slowdown, not so great shakes in terms of China re-stimulating its economy. Right. Basically, you get a divot. It's the upside that we're seeing right now is driven very much by geostrategic and supply disruptions and demand. There's a demand response on the other side of it, which has that that takes you back to the old adage, the cure for high oil prices is high oil prices. We think it saps consumers.
Okay, guys, and I have another one here. Do you have any opinion or takes on the ESG trend or pushes in terms of where that is in the Beltway? Is it all hot air, or is there something on the horizon when it comes to ESG?
So ESG is a term that we all agree it's important, but there's actually no definition to it. The Europeans are working very hard on creating an actual investor definition of what qualifies as ESG. And basically, policymakers here in the United States have decided we're just going to follow what Europe does. So those should actually come out here in 2022, which will give us a little more clarity on what can qualify it. But so everyone's on board, well, not everybody, but a lot of people, especially on the Democratic side, are supportive of ESG. But here in America, the bar is pretty low to qualify yourself as ESG. If you want to market yourself as ESG, there's really no one stopping you from doing it.
Yeah, and there really is the the issue of these are challenging transitions, and we're seeing the in terms of the energy environment, we're seeing a situation in which the clean energy and electrification of the U.S. economy requires over the long term, that's a better and cleaner kind of economy, but that requires a very different set of resources. And the rare earths, the esoteric metals, the things that go into wind turbines and batteries and electric motors and that sort of stuff. These are more complex than the classic sort of carbon chain. And when you add these
primarily they come out of China, which is now basically kind of stopped exporting it because they need it for themselves. So we have to find places, whether here in America or in other places, that are willing to dig up. To get rare earths, you just simply have to dig up the ground.
And processing is obviously a very big challenge, and the supply chains to feed into this transition are not where they need them to be, assuming that
you don't really have supply chains. It's kind of one-offs.
I mean, unless you're willing to just go straight in and just depend on China. And guess what?
That's it. Exactly.
We're not. And so
and that goes back to the national security issue, especially with the infrastructure. If we're past electric cars being a policy thing, Americans want them, whether you get a tax break or not, they're very popular. We have to now figure out a way to produce the amount of batteries that are going to be needed to power these cars. And to do that, you have to dig up the world to get that bottom rung of the table. That's what makes up a battery, and you just dig up the world. China, the north, kind of the border of Mongolia, they have a lake that is completely and utterly polluted. If you step there, your like shoes burn. Like that's the kind of things that happen from rare earths if you don't do it properly. So we in America might not be willing to do it, but I think Africa is going to be a huge battleground in the future over the production of rare earths.
And I think it's very interesting, and it dovetails into something that Brendan was talking about before. It is a topic of conversation on Capitol Hill and elsewhere. Is the way in which government the government is reorienting itself toward industrial policy. The Fed is reorienting itself in a way. Larry Summers has criticized the woke capitalism of the Fed, and I think it's a trend that is going to, whether you like it or not, I think it's a trend that we're going to continue to see. And as we talked about before, in some cases motivated by national security, in other cases motivated by the ways in which Democratic, typically administrations would want to see the businesses and lending and that sort of thing oriented toward a different kind of value conception. Better governance, stakeholder capitalism, whatever you want to call it. Obviously it's not exactly the same on either side of the aisle. It's not as though the Republicans are particularly shy about industrial policy either these days. They just do it in a different way and focus on different industries. So I think it's going to be we're in a tug of war period. It's politicized. It involves, the government picking winners and losers. Different administrations are going to pick different winners and losers, but increasingly they're going to try to do that and reorient the way in which value is understood, and loans are made and that sort of stuff. And
you're exactly right on the loans. That's a risk going forward, especially with the Biden administration's new appointments to the Fed. The Fed is the lead regulator for the big banks, and there is a push within the Democratic Party to have carbon scoring for the loans that a bank made. That is a fairly dangerous can of worms, and you can open up a lot of unintended consequences. It's not imminent, but a lot of the people that are going to be in charge, as long as they make it through the Senate confirmation hearing, are in favor of doing this, at least a certain degree.
Yeah, and I think that this is, our estimation really is however you feel about it, whether you like the idea or don't like the idea, it's more likely that there's more of this coming. And
I agree. Yeah.
more of it coming than less. There's a trend here, and obviously politicized one, but something that we think will have, a longer arc to it.
Okay, gentlemen, I think that puts us right around where we want to be for time. So I want to take this opportunity, of course, as always, to thank John and Brendan, the dynamic duo, for their insights and commentary today. And this concludes our monthly CAPIS research briefing for January. Again, thank you so much to John and Brendan of Markets Policy Partners for participating. Our next research briefing will be on February 17th, which will feature Katie Stockton of Fair Lead Strategy. So everyone, please stay tuned. Keep up with both Market Policy Partners and CAPIS on social media, either on LinkedIn or Twitter or the CAPIS YouTube channel. On behalf of all of us here, thank you so much for watching and have a great trading day.